This week's number 4. California is set to overtake Germany as the 4th largest economy in the world. The state's GDP is already ahead of Brazil, France, and the UK. California's nicknames: the Golden State, the Land of Milk and Honey, the Grape State. Supposedly, Elon Musk is taking Tesla to Texas. I would never trust a man with 6 kids who claims he's pulling out. Wait, I have another joke. Supposedly, there are so many wildfires in California that the air has become toxic. Probably means there's a decent chance I'm going to marry California. That's good, too. Welcome to Prof G Markets. Today, we're discussing Adidas and its competitors, Google and Meta earnings, and then unpack on what to listen for during Fed Chair Jerome Powell's speech later this week. Here with the news is Prof G Media analyst Ed Elson. Ed, what is going on?
Not much, Scott. I have a compliment for you. Do you want to hear it?
I'd like to hear it too, or do it twice.
I only have the one. So I was looking at your YouTube this morning, your interview with Evan Spiegel, and I'm going to read this comment out loud. Is it just me, or does Prof Scott Galloway look quite similar to Ryan Reynolds in Deadpool?
Yeah, I get that actually a lot, but what I usually get is some sort of addendum that like I look like the older Ryan Reynolds or his uncle that didn't get the good genes. I get Ryan Reynolds a lot, but it's usually qualified.
Yeah,
but
I think that makes more sense.
I'm actually thinking of going. I'm in LA to go to all these arrested adolescents Halloween parties, and I'm thinking of going as Deadpool. I'm just a little bit intimidated by the costume because it's very tight, Ed. It's very tight.
Oh yeah, weren't you supposed to be Deadpool last year?
I was, and my assistant keeps ordering it, and it keeps showing up on November the 1st. But tonight might be my night, although I might go as a World Cup soccer player. That might be
nice.
Representing Team
Who are you going to be?
Anyways, enough. Start earning a living. What's in the news?
Well, let's start with our weekly review of market vitals. The S&P 500 posted gains early in the week before disappointing tech earnings weighed it down. The dollar fell to a 3-week low. Bitcoin spiked, rising above 20,000 again. And the yield curve inverted, i.e. the yield on 10-year treasuries dipped below the yield on 3-month treasuries. And that's a classic recessionary signal because it means that investors are placing more faith in short-term bonds versus long-term bonds. Shifting to the headlines. The Elon Twitter deal has closed. Musk finally acquired the company for $44 billion at $54.20 per share. The U.S. economy grew 0.6% in the third quarter after contracting through the first half of the year. Meanwhile, growth in consumer spending slowed, so that's a sign that the Fed's interest rate hikes are cooling demand. VC investing hit a 2-year low in September. Startups received $40 billion in funding. That's down 31% from the previous quarter. And finally, UK companies will likely receive an extra £6 billion in dividends this year, thanks to the weakness of the pound. The pound hit a record low against the dollar last month and then rebounded after Rishi Sunak became the new prime minister. Scott, I'd like your reactions to all of this, but first, could you explain how a weak pound could mean greater dividends for a UK company? That seems strange.
So the FTSE 100 is the 100 largest publicly traded companies headquartered in the United Kingdom, and 75% of their revenue is generated abroad, right? It just makes sense. If you're a Unilever or Rolls-Royce, you're going to get, by the way, I'm talking about the aircraft division, not the car company, you're going to get the majority of your revenues outside the UK. 2/5 of UK-listed companies denominate their dividends in dollars. And with the pound down 14% against the dollar, so if you're Unilever and you sell $100 million worth of Dove products in the United States, you get to repatriate those $100 million at a weaker pound, meaning you're going to get more pounds, which means you're going to report higher earnings or have more capital for a higher dividend. And it's great to get money from abroad when your own currency is weak. You know, sometimes it's better to be lucky than good. And if what's interesting is the UK economy is questionable. It looks like recession's on the horizon, but the biggest companies who tend to have a lot of business abroad are actually benefiting from a weak pound.
And thoughts on Elon, Twitter? What do you think now?
Well, here he is, right? And it closed this morning, overnight. Or on close. It's the second worst acquisition in history. Mm-hmm. You could argue that AOL's acquisition of Time Warner, I think it was like $165 billion, almost right away, was probably worth less than 100. But this overnight, I mean, I don't know if you saw what happened to Meta and Google. The natural level of Twitter's stock price right now is probably around $10. He's paid $54.20. So you're talking about $30 or $35 billion that just went up in smoke. So it's going to be very interesting. Memo got leaked a few weeks ago or a week ago saying it was going to lay off 75% of the employees. What might be interesting is just to see how many people stick around, just to see what's up. My advice or the learning here to young people when you find yourself in a situation where there's tumult is that, one, sometimes dislocation in a tumultuous environment creates a lot of opportunity. If the 3 people running your department leave, they might look around and decide that you're the person that should run the department. And 2, I don't think you ever want to leave a job until you have another one. It's just much easier to find another job when you have one. And also, if you're at Twitter and you're one of those 75% of employees that get laid off, if in fact that memo or that leaked information was true, you're going to get severance. So I always say to people, one, never quit without speaking to people who don't work at the company, who you trust and have a vested interest in your success. You never want to quit out of emotion. You always want to have another job unless you're planning to take some time off. And in great periods of disruption, there's always enormous opportunity. Now, having said that, I think the company's going to be a total shit show. I can't imagine they're not incurring the same macro headwinds as every other digital marketing company right now. If Meta and Google are throwing up, I can't imagine. I just can't imagine any advertiser thinking, I know, let's advertise on Twitter right now. So this is going to be a very interesting 90 days. What do we know, though? This is already the second worst acquisition in history.
Mm-hmm. Do you think it's a good idea to lay off 3/4 of the staff, just from a business perspective?
I think layoffs are probably warranted. I've never understood why this company needs 7,500 people. Pinterest, Twitter, and Snap all get about $600,000 in revenue per employee. Meta and Google get about $1.6 million. And also, I've been meeting with a group of entrepreneurs who are doing startups or thinking about startups in the social space, and all of them have said something really interesting, and that is what used to take 10 engineers in 6 months, because of advances in cloud technologies and I don't even call them, but modules, things you can just turn on. What used to take 10 engineers in 6 months oftentimes now takes 1 engineer in 6 days. That the progress you can make on a programming front and a feature functionality front because of advances in the cloud is just so extraordinary that you can do a lot more with less. So I wouldn't be surprised if Twitter, I think the plan is to try and hold on to 80+% of the revenue with potentially dramatically fewer people. In a company like that, the majority of its SG&A is the people who are paid very well, and there's a lot of them. So you're going to see, and I said this on Pivot, what happened when Elon Musk announced potentially, or quote-unquote memo leak, that he was thinking about laying off 75% of employees. A lot of employees at Pinterest and Snap probably lost their jobs. They just don't know it yet.
Do you think they're just going to follow what he's doing? Because why would they follow what he's doing?
Well, everyone thinks he's a genius, and I think also there's some merit to the fact that these companies saw themselves as growth companies. Aswat Damodaran, my colleague at Stern, says the companies refuse to ever believe they're no longer teenagers. These are no longer growth companies. The revenue is flat to down, and yet they keep hiring like crazy. And when you're stuffing calories down an organism's throat, and that is a company that everybody thinks should be fed like a growth company, but it's no longer growing, pockets of fat build up. So, easy for me to say because I'm not there, and I've even heard from some Twitter employees that said, you don't understand, that we're more efficient than you think. I have a difficult time understanding why you need more than 2,000 people to run a microblogging platform. It's not like they have maps or, they have a video platform. The product really hasn't changed a hell of a lot. And they have fewer advertisers. I'm sorry?
There's just an edit button. That's the only innovation I've seen in the past, 4 or 5 years. You can now edit your tweets on Twitter Blue,
maybe a blue check. It really, it doesn't appear like there's a lot of technological wizardry there. So I think, but we've said before, this recessions are either called a white-collar or a blue-collar recession. We think this is going to be the Patagonia vested recession, and that is a lot of the people who've been hired into a growth economy, who live in Brooklyn and take their dogs for long walks and expect pet bereavement leave, are in for a rough ride here for the next 12 to 24 months. I think there's going to be a lot of layoffs.
Yeah.
Yeah, you.
Okay.
No, you're in trouble. By the way, we need to speak. We need to speak.
Well, as usual, we got derailed by Elon, but let's move on to the first story here, which is Adidas. Adidas is ending its partnership with Kanye West after he made a series of anti-Semitic comments online. The company will stop producing all Yeezy branded products, which will have a significant impact on the business. The Yeezy line made up 8% of Adidas' sales and roughly half of its profits. And as a result, the company expects to see a $250 million hit to earnings next quarter. Adidas stock is down 16% since October 6th, when the Kanye controversy began, and year to date, it's down more than 60%. So, Scott, this is clearly a big economic blow to the company. With that in mind, do you think Adidas made the right decision?
100%. And this really wasn't a decision. They had to do this. And they've gotten a lot of grief because I think it took them 10 days to officially announce it. And I was one of those people giving them grief, basically saying, you're going to separate from them. So why wouldn't you do it sooner rather than later? And the longer you wait, the less credit you get. But having reflected on it, hearing about just what a big business it was, it's difficult to shut down a business like that responsibly. You got to communicate with your retail partners. You got to communicate with your supply chain. There's probably a couple thousand people just working on this business. You got to communicate to them what's going to happen. You got to figure out, you got to communicate to your retailers, this is what's going to happen to the inventory. You got to figure out an investor relations strategy around what this means in terms of projections and forward-looking statements. So the fact that they announced this 10 days after Kanye made these statements probably means they made the decision about 10 minutes after. And I think they deserve real credit. And something I'm trying to do is, rather than constantly threatening to boycott products, I want to reward companies that do the right thing. And I put out a tweet saying I was going to wear my Adidas Superstars, hello 8th grade, with the seashell toe cap. Hello! That's how you lose your virginity at 19, Ed. Anyways. No, I think they did the right thing here. And crisis management is always difficult. You have to acknowledge the problem. The top guy or gal has to take responsibility for the decision, and you need to overcorrect. But my favorite thing was that supposedly Kanye was escorted from the Skechers headquarters after showing up unannounced. So rock, meat, bottom. When you're kicked out of Skechers HQ, I mean, that's pretty tough. That's pretty tough. Pretty soon he's going to be a backup singer in the Taylor Swift band. This guy's career it's not going well, Ed. It's not going well.
How much of this do you think was also a financial decision by Adidas? Because there's the moral side, which is we don't want to partner with an anti-Semite, someone who just puts a lot of hate out there. But also they might have been thinking, if we keep partnering with this guy, people aren't going to buy our products. They're going to boycott us. So what do you think of that? Was that a financial decision as well, do you think?
Yeah, this was a capitalist decision, and that doesn't necessarily mean that they shouldn't get credit for it, but people they were just going to get literally a torrential downpour of shit for the next several months if they refused. You were going to see people burning their Yeezys on. I mean, it would have never stopped. They had no choice here. Unfortunately, it comes at an especially inopportune time for Adidas, who is, like a lot of consumer companies, showing weakness, and even relative to their peer group, they've been struggling. Their stock is way down, as you referenced, and also the stock actually even I would argue, looks cheap. And I think that's kind of a learning here, is that there's usually opportunity in bad news. And that is, there's just a perfect storm of bad things right now at Adidas. There's loss of this hugely lucrative partnership. Their core business is weak. So as a result, you have a company with a market cap now of about $18 billion. And one of the things I like to do is I like to look at market capitalization relative to brand equity as a brand strategist. We even have a session on this in my course. I think $18 billion for an iconic century-old brand that has real aspirational value and is probably it's maybe a distant number two, but it's a solid number two to Nike. I would argue that feels cheap to me. And then if you look at the numbers, you do in fact see that relatively speaking, the stock looks cheap. And keep in mind, stocks, the pendulum is never exactly at the bottom. I would argue stocks are almost always undervalued or overvalued because we live in sort of the markets are sort of bipolar. They love you or they hate you. And right now they hate Adidas, but its EBITDA is about $3 billion, so it's trading at about 6 times EBITDA, whereas Nike, in contrast, is trading at about 20 times EBITDA. So Adidas is $24 billion, so its multiple or its revenues to market cap is about 0.8, whereas Nike does $47 billion and has a $145 billion market cap. So its market cap to revenues is about 3. So you have Nike on a relative basis is trading at about 3x the valuation of Adidas. What this probably says is that Nike is either overvalued or Adidas is undervalued. And then another interesting comparison is On Running, which are the shoes I've been wearing because, midlife crisis, arrested adolescence. And On Running has sort of captured this lightning in a bottle. It's a very cool little hip brand. It does, get this, $1 billion in revenue, and it has a market cap of $12 billion. So its market cap to sales is 12, and it's growing really fast. It's a hot brand and all that. And then I think kind of the laggard in the space is, I'm not even going to talk about Allbirds. That's a retailer, and I think Allbirds could literally go away. But Under Armour, which was once kind of a hot brand, has sort of fallen from grace to $6 billion in revenue. And it has a market capitalization of $3.5 billion. So that trades at like 0.6 market cap to revenue. So you kind of have the whole spectrum here. You have the hot brand that's trading at 12 times revenues. You have the iconic leader trading at about 3 times revenues. And then you have the semi-icon who's had some real hits trading at 0.8 time revenues. So I would argue that the opportunity here from an investment standpoint is actually with Adidas.
Yeah, when we discussed this week, you used the word dislocation, that there's dislocation happening to Adidas because of all of this news. Can you explain what you mean by that?
Well, Kanye has admitted that he's been diagnosed with bipolar disorder. And I would argue that the markets are bipolar. So bipolar is manic or manic depressive, right? Someone experiences mania, which is sort of hard to describe. I don't want to be disparaging of people suffering from mental illness. People understand what depression is, but mania is this feeling, this highly alive, awake, very, everything's good, kind of irrepressible amount of energy, very kind of promiscuous with your ideas, and this sort of irrepressible energy over the top that's usually followed by a crash into depression. And I think it's a really interesting way to describe, or an apt way to describe the markets.
Yeah.
And that is good news. Everything's great. We're unstoppable. The stock is unstoppable. It's to the moon. Let's take it up to 12 times revenues. And then there's depression. Oh, no, they lost Kanye. Oh, no, the brand's not doing well. I hate this thing. The world is black.
Yeah.
This stock is black. Let's take it down to 0.7 times revenues. So I think the markets could be diagnosed as what I'd call having mild bipolar syndrome.
Right.
But this is when you have bad news and you have dislocation, you have tumult, no obvious answers, a lot of unknowns, a lot of volatility, which is what Adidas is experiencing right now. That usually spells opportunity.
Yeah.
And that is when everybody hates something, that's a decent time to go into it. When everybody hated Florida real estate in 2010, that was absolutely the right time to get into it. Now that everyone loves Miami real estate and rents have skyrocketed and home prices have skyrocketed in Florida, I would argue it's probably not a great time to invest. So I in sum, run into the fire. And what is the fire right now? Adidas.
Yeah. Google and Meta posted earnings last week, and both were a disappointment. Google reported slowing revenue growth for the 5th straight quarter, and YouTube revenue dropped for the first time on record. Meanwhile, Meta posted its 2nd consecutive actual revenue decline. Quarterly revenue came in at $28 billion, which is down 4% from a year ago. and shares in both companies declined significantly. Google shares fell more than 6% on the news. That stock is down around 35% year to date. And Meta shares fell, get this, 20%. Meta stock is now cheaper than it was 5 years ago.
This is just the mother of all kind of dog bites man. I can't get over this. Do you realize that ByteDance, the company that owns TikTok, is now worth more than Meta? I mean, that's just incredible. And Meta has lost 5 or 6 years of stock market gains. It's incredible. And then when you look at everybody, when you look at Snap throwing up on themselves, when you look at Meta's weak numbers, flat to down, when you look at Google slowing down, YouTube was the growth engine, that slowed down. It's reminiscent for me of what's happened the last 20 years in retail.
Yeah.
And that is, I don't care what retailer you were talking about, whether it was Macy's, whether it was Walmart, whether it was Urban Outfitters, a company I served on the board of, we'd have some signs of hope, every once in a while a good quarter, and then we'd have an okay quarter, and then we'd have an awful quarter. And it just felt like everything was hard. Everything was getting a little bit harder. And the reason why was because it was getting harder. Specifically, every day, Amazon took more and more money out of the ecosystem. And what do you have happening here? TikTok, I think, went from $4 billion to $12 billion in revenue last year. It'll easily go from $12 billion to $24 billion. So you have $12 billion in incremental revenue going to TikTok. Now, in addition, you have everyone from Hulu to Apple TV to Netflix announcing that they're going to have commercials. So say they find $10 billion in advertising revenue. That's $22 billion in incremental advertising revenue that's coming from a zero-sum pie. What do I mean by that? Advertising as a share of GDP, or the total amount of money that brands spend on advertising, has been flat for 5 decades. And guess what? It's not going up. As a matter of fact, with these economic headwinds, it's probably going to come down. So the existing players, whether you're Google, whether you're Meta, whether you're Time Warner, your $24 to $30 billion is going to be taken out of the ecosystem and go to these new players and to TikTok. So just as Amazon was sucking the oxygen out of the room day by day for all of retail, you have TikTok and then these new streamers sucking the oxygen out of the room for the ad-supported ecosystem, including Meta and Google. It's really extraordinary. These companies are no longer growth companies.
Yeah. Yeah, and the other thing we were talking about this week is Apple and Apple's privacy change, which happened earlier this year. It basically meant that users have to say yes to being tracked. And I saw this stat yesterday. Users agree to be tracked only 16% of the time, which means that Meta and Google and all these digital ad-supported platforms don't have access to that data that they were getting on iPhones and on Macs and iPads. And it seems like that has just crushed the digital ad business. So do you feel like that's also an important thing to be thinking about?
So the two kind of elephants in the room here are TikTok, which is this ascendant growth company, and Apple, which is throwing its weight around. Yeah. Apple controls the interface and said, I know privacy is core to our brand. I hate Mark Zuckerberg, said Tim Cook every night before he goes to sleep, and said, I know, I'll give people the opportunity to opt out of tracking. And overnight, that kind of kneecapped Meta's ability to collect first-party data, and some knock-on effects here. I'm in the online education business. Acquiring new consumers became 40% more expensive overnight. It's really had a lot of knock-on effects. Even small businesses, their cost of customer acquisition have gone up. And speaking of being bold and confident and throwing your weight around, Apple has just announced, if I understand it correctly, that if you boost your advertising for a piece of content in the Facebook app, they're going to try and take their 30% fee on that boost, or I don't know if it's 30%, but they're saying that they're entitled to a commission on increased expenditures in advertising to boost content if it's done through an app on iOS. I mean, that is really throwing their weight around. But what you have with Meta, you have a company, one, that is flat. It was minus 4% year on year. It was up 2% on a constant currency basis. And what you also have, though, is you have a company that increased its spending dramatically. You have a company that was flat, but I think its costs were up something like 20%. All of that leads to a massive decline in earnings.
Yeah.
When your revenues are flat, but you hit plan in terms of costs, what do you end up with? You end up with a decline in earnings of 52% year on year, which is what happened with Meta. So right now, if I'm looking at the right numbers here on Meta, it's trading at a price earnings multiple of, get this, I think around 7 or 8. This is what old economy manufacturing companies trade at. The PE right now is 8 because people see, all right, you got a guy who can't be controlled. He controls the company. He's all in on the metaverse. He's already rich. He doesn't care about money. So his attitude is, I'll show you. I'm going to prove everyone wrong and keep going all in and spending tens of billions of dollars on the metaverse. And shareholders are in the back seat, buckled in, and they can't get out, and the doors are locked on this crazy, nauseating ride called the metaverse.
Yeah. Yeah, it feels like he just used the metaverse as some sort of shortcut to say, yeah, we're a growth company. We deserve massive multiples. And then everyone just said, don't agree, don't
Where's
believe
the growth?
it. Yeah, there's no growth.
Yeah.
I want to bring up a letter that Brad Gerstner of Altimeter Capital wrote to Meta and the Meta board. So he said he asked for a bunch of major changes. Well, 3 major changes. He said, 1, reduce headcount expense by at least 20%. 2, reduce annual capex from $30 billion to $25 billion at least. And 3, limit investment in the metaverse / Reality Labs, that's their metaverse unit. Limit that investment to no more than $5 billion a year. Do you agree?
Well, let me be clear. There's a big difference between being right and being effective. Yeah. And Brad is right, and he will be totally ineffective. All you're doing when you buy shares in a dual-class shareholder company and then telling them what to do is pretending that the company, or deluding yourself into believing that the company will be rational and that your force of character and logic will win over someone who controls the company.
Could you explain dual-class shares briefly?
It's Kremlin politics. It's okay. You get shares. The Class A shares are the voting shares, and Mark Zuckerberg has, call it 51% plus of the voting shares, meaning that he effectively, when shit gets real, when there's anything that's important, he gets to make the decision. Mm-hmm. And dual-class shareholder companies were initially structured by media companies that didn't want to be subject to the short-term whims of shareholders so they could have an independent newsroom, blah, blah, blah. And then everything changed when Google structured their company as dual-class shareholder. And now a lot of companies do it because you have founders who say, well, I'd like to sell most of my shares, but I'd still really like to control the company. Yeah. And this is where it comes back and haunts you. And that is, if this was a single-class share company, when Brad wrote that letter, a bunch of shareholders would call Mark and say, Brad's right. And if you don't stop this, we're going to replace the board, and then the board will replace you. But instead, a board of directors in a dual-class shareholder company isn't really a board of directors. It's a board of advisors, because at the end of the day, Mark can do whatever the fuck he wants, and all they can do is just advise him and show up every 3 months for a free dinner and cash their $200,000 a year board checks. But you have absolutely no power in a dual-class shareholder company when you're the Class B shares. The Sulzberger family now only owns around 2 or 3% of the New York Times company, but they control the company. The Ford family controls single-digit percentage of Ford, but they control it. Yeah. And in general, it is bad to separate economic risk from accountability and control. Because if you're Evan Spiegel at Snap, who, by the way, I think is a really thoughtful young man, I think is a great operator, but he's already a billionaire. What's his motivation to sell the company? No, he wants to prove them wrong, and he controls the company. So these companies are what I'd call usually fairly investor unfriendly. They go dual class early in their career when they're really hot, and investors will put up with it. And everything's fine as long as it's up into the right.
Yeah. No, it feels like the perfect case study in the dangers of dual class shares. But we were talking about dislocation earlier. This doesn't really fit in because its actual fundamentals are down. But do you feel like because Meta is down so much, it's where it was in 2016, 2017, do you feel like this is maybe a buying opportunity? Yeah,
so I want to be clear. I think Meta is a net negative. I think big tech is a net positive. which isn't to say we shouldn't hold them accountable. It isn't to say we shouldn't look thoughtfully at them and potentially break them up, which isn't to say that they shouldn't be subject to the same scrutiny as other companies. But if you had a button and you could press it and all of big tech would go away, you wouldn't want to press the button. We're net gainers from big tech. I think we're net losers from Meta. I think Meta has done so much damage to our elections, our discourse, and to teens that if you had that button, you might consider pressing it. Having said that, when you have a company that has a core business that is a cash volcano, and it's trading at a price-earnings multiple of 7, I'm not going to buy it because I don't want to support the company. I don't want to help finance it. But you do not, in my view, you want to be very careful about shorting this stock because the stock could double from here just and have a multiple that wouldn't look like an expensive multiple. By all traditional metrics, this company looks cheap. What they're paying or what's happening here is there's what I'll call a Mark Zuckerberg crazy fucking metaverse discount here. But this feels cheap. This company now feels almost like a distressed asset.
Okay, we'll be right back after a quick break with an unpack on the peculiar history of Fed chair comments moving the market and how to interpret Jerome Powell's speech this week.
Okay, I was a fucking genius there. That was just extraordinary. You're welcome. You're welcome. You're welcome. God. Hello, gun shows in town. Where's that naked guy?
All right.
He was wearing Under Armour underwear. Who the fuck stays at the Beverly Hotel and buys Under Armour underwear?
Is he at the Beverly Hills? He's in the same hotel?
That's where I am. I'm at the hotel. Seriously, I won't show him to you. I'd probably get sued for that. Oh, he subjected us to nude men. Anyways.
Yeah, I'm going to report you for that.
I'm going to meet him for drinks later. He looks like a Ron. I think his name is Ron. I get the sense his name is Ron.
Okay.
Dun, dun, dun. Dun, dun. I'm sorry. Anyways, Jason, unpack.
Markets news is often about the numbers. It's the domain of stock prices, statistics, and ratios. But sometimes a few words can be more powerful than any number, especially when those words are uttered by the chairman of the Federal Reserve. For decades, traders have been hanging on the sometimes cryptic statements of the Fed chair. This Wednesday, current Fed chair Jerome Powell is scheduled to hold his bi-monthly press conference, and the financial world will once again be reading the tea leaves of his comments. For more on this tradition, here's Prof G Media's editor-in-chief, Jason Stavers, with this week's edition of The Unpack.
Ed, being chairman of the Fed must be a little like being Aladdin with your lamp. Your words are suddenly imbued with great power, but you find out pretty quickly that you have to be very careful what you say. The genie of the market can be tricky. So the modern history of Fed chair statements moving markets begins on October 6th, 1979. Paul Volcker had been Fed chair for just 2 months, and on a Saturday afternoon, he summoned the press to the Fed's D.C. headquarters, ostensibly to announce a technical change in how the Fed would be implementing monetary policy. But everyone present understood that behind the technical change he announced that day, a revolution had taken place within the Fed. A new intellectual regime was in place, one that would aggressively raise interest rates, choking off the supply of easy capital for corporate America. Over the next week, the Dow Jones Industrial Index had some of its worst days of the decade, and it lost nearly 7%. Bonds were also crushed. By January, the economy was in recession.
Careful what you wish for?
To an extent, yeah. Volcker surely knew that his words would suppress valuations, but no central bank chair wants to watch the country's debt and equity markets just sink day after day. And Volcker himself repeatedly said that market volatility was a problem he wanted to avoid.
And how did that turn out?
Well, whether it was Volcker's interest rate increases or just the natural turn of the business cycle, inflation was eventually tamed. But Volcker wasn't the last Fed chair to spook the markets. The most famous example belongs to Alan Greenspan, who ran the Fed for nearly 20 years, from 1987 to 2006. Greenspan was famously cautious in his public pronouncements. He relied on vague language, and he hedged everything he said. He gave no radio or television interviews during his tenure, and even had his PhD dissertation removed from the NYU archives when he became Fed chair. But if he was hoping that this would reduce the impact his words had on markets, he had to have been disappointed, because the opposite happened. Deciphering Greenspan's every word became an obsession. Academics even wrote papers analyzing how he used language. In 1996, he gave a speech at the American Enterprise Institute. Stock markets at the time were in a prolonged bull market, driven in part by highly valued tech stocks. So Greenspan in this speech posed a rhetorical question. He said, quote, "But how do we know when irrational exuberance has unduly escalated asset values?" That phrase, irrational exuberance, probably became the two most expensive words ever uttered. The Japanese stock market was the first to open after Greenspan's speech, promptly lost 3% of its value. The Dow fell 2% in the first hour of trading, and the New York Times headline the next day read, "Stocks worldwide dive as Greenspan questions euphoria."
One person's comments can cost investors billions of dollars. In fact, it seems like a terrible system. Is that right?
Yeah, it doesn't seem that great, does it? So Greenspan's successor, Ben Bernanke, was pretty concerned about this. And so he tried sort of the opposite approach from Greenspan. Rather than speak rarely and as obscurely as possible, he implemented regular press conferences. He hoped that he could sort of smooth out the impact of his statements, basically by making more of them.
Did it work?
Well, to a degree. Bernanke himself kind of sabotaged the system on occasion. So, for example, in 2006, he was at the White House Correspondents' Dinner, sitting next to a CNBC anchor, and he made an offhand comment about the Fed's plans with regard to interest rates. She reported that comment on her show the next afternoon at 3:15 in the afternoon, and by 4, the stock market had gone red. So, overall, though, more communication from the Fed chair has somewhat formalized the process, in that we know when the Fed chair is going to speak, and a kind of informal code has developed between the chair and the market.
Okay, so Jerome Powell is holding his press conference this week. What do you think we should be expecting?
Well, this history of Fed chair statements is interesting in part because we haven't really tested the system in a while. Until this year, it had been a decade since the market was hypersensitive to the Fed's moves. We've been in a consistently low interest rate environment with no real expectation that would change. That's not true anymore, as the Fed has been raising rates to fight inflation. And so Fed watchers are dusting off their Fed chair translators and once again hanging on the chair's every word.
We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we're confident the job is done.
So in anticipation of Powell's speech this week, we spoke with Bob Iacchino. He's a trader, the chief strategist at Path Trading Partners. Bob explained what traders will be listening for when Powell takes the mic on Wednesday.
Essentially, you first look at the statement, okay, and the statement will have key phrases in it. Those are the places where you would look for it to change up. So, for example, inflation remains elevated. They might change that to inflation has moderated. 2 or 3 meetings ago in the statement, they said we're looking for substantial progress on the rate of inflation. They might say we're seeing marginal progress. It's those little key words that directly affect the actions they might take in the future, not what they just took, but what they might take in the future that you're looking for changes in.
And that's the key to all this Fed watching. The markets have already digested what the Fed has done. They want to know what it's going to do. And the best way to figure that out is to listen to the Fed chair. Jerome Powell speaks on Wednesday, November 2nd at 2:30 Eastern Time.
Thanks, Jason. Scott, do you listen to the Fed chair? Do you pay attention to what he says? And if so, how do you interpret his words?
I don't, but I'd hate to be a speechwriter. I'd hate to be the person responsible for trying to assemble these words, recognizing that anything could be taken out of context and create a cartoon, and then it's irrational exuberance, or, this guy really does move markets. If you wanted to move the markets up, probably 2,000 points in 15 minutes, if Jerome Powell said something to the effect of, our efforts appear to be paying off with respect to the reduction in inflation, that would send a very strong signal that they were about to do kind of the pivot to a more dovish or stop raising interest rates, and you would see the market scream. I'm not saying that'd be the right thing to do, because if inflation does in fact, he's got to get his arms around inflation. His hero is Paul Volcker. I think he's absolutely doing the right thing. Some people are faulting him for not doing the right thing soon enough. But there is even some evidence out today that the economy grew and inflation didn't grow at the same pace. So growth minus or growth up, inflation sideways or down is a really good print. That's a really good number. But no one has their words parsed like Chairman Powell. And I would argue most of the time there's not a there, that they've got to finish the sentence. They've got to put words there, and they're going to respond differently. But it's a very strange situation around how markets absorb a language and then act on it. It's almost become a game.
Yeah. Do you think it's a bad system? I mean, I don't know what the alternatives are, but it just seems so rudimentary that our entire economy is based around whatever this guy says.
Yeah, I think it was either you or Jason brought up an excellent point in our editorial meeting that in China, they just stopped giving guidance, and that people don't trust the numbers that come out of their system. And key to economic growth is trust. And so I think the chairman communicating or over-communicating is really a powerful positive, or a positive sign for our economy and our democracy, and you try to be as transparent as possible. The learning here for young people is in relationships and in your personal life and your professional life. When things aren't going well, or it's a tense time in a relationship or a business, you want to over-communicate.
Yeah.
And that is the market and your spouse and your parents and your friends, they don't like bad news, but they can tolerate it. What ruins relationships is surprises.
Yeah.
Wait, you knew this was going on and you didn't tell me, and now it's worse? So the fact that we consistently publish minutes of the Fed meeting, the fact that he will come on during very tense times and tell people the hard truth, the fact that our inflation and GDP numbers have more veracity than the numbers that the CCP releases is really a positive forward-looking indicator in our economy. And it's the reason why the dollar is the reserve currency. Yeah. It's the reason why people want to own American stocks. So I think it's a good thing. This gamification of parsing his words, that's a bit of a sideshow. But constant communication with accurate data that is honest is a feature of a working capitalist society.
I love that. Only you could turn Jerome Powell's speech into relationship advice.
There you go. Call me the Esther Perel of the economy.
That's good, actually.
Hello.
Okay, well, let's take a look at the week ahead.
You can recover from an affair, Ed. Now think of your life moving forward.
Yeah.
That's right. That's right.
Okay. Let's take a look at the week ahead. We'll be watching for that next interest rate hike decision from the Fed on Wednesday. Mm-hmm. And we've also got earnings from Airbnb, from Uber, and from CVS. Do you have any predictions on this or on anything else?
My prediction is in the next 6 months, 10,000 people are going to be laid off from ad-supported big tech, Twitter, Snap, Meta, and Google. These companies have just gotten too big. You stuff so many calories down someone's throat. They build up pockets of fat. And here comes Jenny Craig, or I don't know what the right analogy is, but, the liposuction, Anyways, Ed, you get my meaning. Anyways, I think you're going to see massive layoffs across big tech and the growthy part of the economy. Maybe even, it's going to be big. It's going to be big, Ed. All right, that's all for this episode. Our producers are Claire Miller and Jason Stavers. Special thanks to Catherine Dillon, Ed Elson, and the Prof G Media team. If you like what you heard, please follow, download, and subscribe. Thank you for listening to Prof G Markets from the Vox Media Podcast Network. We will catch you next week.